The difference between reality and fiction has to make sense. Tom Clancy, one of my favorite authors. And that is so very true. In fact, the financial news media every day presents you with what sounds like, because you hear it every day, a reasonable sense of reality, that you can't figure out what's going on, that you have to have experts breathlessly telling you what you should think, even though when you pay attention to what they say, it really doesn't make any sense. But people in nice studios with white teeth and perfectly coiffed hair, beautiful suits, are sitting in front of cameras with great graphics and telling you what reality is when it's not actually reality. They are the message that comes between the advertisements. What we talk about here is objective reality. We, my friends, are looking at price movement. And price movement is what is real. That's what we pay attention to each and every day. We break it down. I get your emails. I got several nice ones posted at the YouTube channel, emails last night. Appreciate the new Patreon members and support. Appreciate the new book buyers. Sent out invoices to our overseas friends wanting to buy the book. Sent out books today. If you want the book, let us know. You can see the link in the show notes if you live in the States. If you're overseas, simply write us cw@chartingwealth.com. We'll send you a PayPal invoice. Pay it. We'll get a book to you. You want to be a Patreon member, see the link in the show notes. Sign up. Now, let's talk about what's going on, what we saw happen over this past week, what we see potentially coming this next week, where we are with the market. First and foremost, remember, market is in flux. We are in the crappy time of the year, in the summertime trading zone, which sucks. That's just the only word we can use for it. Typically, a lot of the volume starts going out in the market. Sell in May and go away. Live to trade another day. That is an old saying in the market, meaning that a lot of people go on vacation, take breaks, go see the world, who are up in the financial markets. And historically, a lot of the volume leaves the market, which means the market's much more up to and able to go up and down sideways, not be something that's as good and predictable as it can be in the fall-winter trading zone. Now, we are not seeing that occur yet. We're just seeing the market trying to shake out and get its legs. Of course, we had all that China news at the beginning of the week where the market hammered down. Then over the next few days, we had the market move back up and recover the losses. And now we see it seesawing again, down on the S&P 500, 0.61% for the day. NASDAQ 100 down 1.02%. We see 20-year bonds are up. Gold is down, which is nice. Seeing gold again resume its drive down. But we're going to get a good look at where the candle is for the week. That is the weekly candle. We're going to look at sort of how things are shaping up and get a good idea as to what we can look for potentially occurring over this next week. And again, remember, we have to have trends to follow to do trades and investments. These are all practice trades, practice investments. Again, caveat, you're not paying us for anything. We are not a stock calling service. We're an education firm. And that's what we want to do. We want to educate you. We want to empower you to see reality. That's what we do. We keep it simple, but we keep it effective. What could be better? What could be better? Instead of all this complicated stuff that doesn't work, that you never understand, maybe you're not supposed to understand it. Maybe you're supposed to think you're too stupid to understand it, so they win. Well, we're going to win. Let's talk about what's going on. S&P 500 down. We see a down candle for the week. Our Heikin-Ashi average pace candlesticks. If you've not taken that training, there's 113,000 people ahead of you. Go ahead and take it. It's available for free at the website. I'll also link it at the end of today's video. If you're listening via our podcast, just go to chartingwealth.com and go under training, look up Heikin Ashi candlestick. We see that the Heikin Ashi candlesticks are showing the average pace of the week is strongly down. We have the derivative oscillator losing momentum. Price percent oscillator also heading down. Don't have a weekly vertical crossover, so we're not calling the market down yet. Our trend line is well broken. That actually happened in the prior week, but we do have a strong down candle. Now, that doesn't mean that the market's capitulated. It just means that we have a second down week. What do we see with the latest 2-day candle? Well, it ended today and it's a green up candle pushing through the 2-day trend line. Derivative oscillator still gaining downward momentum. Price percent oscillator still heading down. So there's still that downward pressure on the 2-day chart. We're seeing that reflected in the weekly, but not enough to rotate the weekly over yet. 2-day isn't a confirmed down move, which of course means the 2-day and the weekly are moving in opposite directions. We don't have a trade. We're waiting for things to sort out. What do we see on the 4-hour chart? It crossed over going up back in the morning on Thursday, the 16th, and we see that it has sort of leveled out, and what it did over the course of the day was go down, really more sideways. And again, we'll keep our eye on things and wait over the course of this next week to see if that downward pressure is going to push everything over. Now, don't forget, where are we on our quarterly chart? Our quarterly chart, we don't talk about that typically but once a quarter, but if you remember, our quarterly chart is down. Price percent oscillator crossed over going down back at the end of last year. Derivative oscillator gaining downward momentum. That price percent oscillator is pretty much running parallel because we've had an up quarter so far. Not strong enough, however, to counter the down pressure. So the real pressure is coming from the biggest wave, our quarterly chart. Keep that in mind. Keep that in mind. Keep that in mind. Okay. Enough said. We're going to go back to the weekly chart and going to the NASDAQ 100. We see, just like the S&P 500, a big down candle. No wick on top like the prior week. Simply a solid red candle with a wick on the bottom. All the movement down. And we see the price percent oscillator heading down. Derivative oscillator. Both of these are still positive, but losing momentum as oscillators. What do we see on the 2-day chart? Again, a bit of a pullback, but not enough to push through the 2-day trend line. Derivative oscillator still heading down. Price percent oscillator heading down. And that 4-hour chart, we see that it is down for the day, trying to push back through that 2-day trend line. So again, we'll continue to watch over the course of this next week if there is a weekly vertical crossover going down or if things are just going to run out of that downward momentum and start heading back up again. Remember, we typically see a summer low. That could be where we're headed. And if we have a weekly vertical crossover, that's going to give us the trigger pull to jump into a down move. But not before then, because if you tried that on Monday, you'd have gotten hammered this week. Correct? Correct. That's why we do what we do, because our rules work almost all the time. Let's go to TLT 20-year bonds. What are they doing? Up for the day, 0.22%. Second week of up movement. Look like we're going to have a crossover going down. In fact, it did during the week a couple of times back on the week ending the 3rd of May, but it pulled off, bounced off that red signal line and started heading up. Second week of decent up movement. Nice up candle above the weekly trend line. And the price percent oscillator also turned positive. Well, price percent oscillator heading up. Derivative oscillator also turned positive. Look at the 2-day chart. We see price movement, just a nice 8 days of nice up movement. Actually 10 when we go back to when that 2-day crossover occurred. Price percent oscillator heading up. Lost a little bit of momentum over the course of this past week. But it does look like as we look at the, looks like when we look at the candles, they topped out over the last 2 weeks at about the same spot. Derivative oscillator heading up, price percent oscillator heading up. I think I said 2 weeks, over the last 4 days, forgive me. And we go from the 2-day to the 4-hour, and that's where we see that in that sideways slide. Actually, not over, over 3 days we see that occurring. So again, Looks like it was trying to end the day, not quite crossing over, going down. We've been waiting for that pullback, have we not, my friends? We've been waiting for a pullback because we've not had a jumping in point since we had that crossover. The 2-day candle ending is that it was either Tuesday or Wednesday. I'm trying to figure that out on the 4-hour chart, but we had that crossover on the 2-day chart. We've not had a pullback yet to give us a trigger point. For those of you who are new, we use our 4-hour chart as a trigger. That means that typically after we've already had a weekly vertical crossover and some trading opportunities, we wait for the 2-day, which will at times go in the opposite direction of the weekly, to move back in the direction of the weekly. That then sets us up for an entry point with the 4-hour chart. We wait for the 4-hour chart to back up, that is to move in the opposite direction, which it looks like it's trying to do, of the larger candle, the larger time periods, the larger charts, both our weekly and our 2-day. And then once it moves back over heading up, that's our trigger to jump in and on it and make it work. So we'll see if indeed that occurs over the course of this next week, something for us to watch for. And if that occurs, that might give us a trading opportunity. Note that on your weekly market worksheets. If you don't have a weekly market worksheet, daily market worksheet, or trade worksheet, don't forget those are available for free in the show notes. If you're not a subscriber, go to chartingwealth.com and sign up. I will tell you, we've had a little bit of trouble over the course of this last week. Rabin, who is our master decoder and fixer of all things interweb, has been working to get it back going again. We've had IP screw-ups, and I don't know. It's not his fault. He's fixing it. Hopefully, you're receiving the email over the weekend. Of course, everything's always available at chartingwealth.com and at our YouTube channel, but we need you to subscribe so we can send you all the newest trainings when they're available, plus special notices about new publications and all the stuff we have happening. So if you're not a subscriber, go to chartingwealth.com, sign up. You'll appreciate receiving only once a day our daily reviews. And then, of course, on Fridays over the weekend, you get the weekly review and forecast, what we call our comprehensive review, plus the special trainings when they come out and all the other good stuff. Nobody spams our list. We do not share it. We do not spam it. Okay, lastly, we go to gold. What's gold doing on our magical weekly chart? Well, we had a weekly vertical crossover on gold back on the week ending the 29th of March, and it was gone over that time period down 4 of those weeks and slid sideways over the prior week. This week, it's a green spinning top, which of course means indecision tending up, not nearly as much as the prior weeks was. But the price percent oscillator still heading down, derivative oscillator losing downward momentum, down day 0.72%. Prices moved all the way down again to 120.64. So again, we saw it bottom at about 119.50, something along those lines. So let's see if it's going to keep moving down toward that. Of course, that price percent oscillator is telling us on the big chart it is going to keep moving down. Again, subject to change, but that's what we're seeing on the big chart. Latest 2-day candle, strong down candle. We can see the price percent oscillator heading down, derivative oscillator losing upward momentum. Hasn't crossed over yet, but did plumb down all the way, gosh, how low did it go? Let's see. Went all the way down to 120.33, so that's interesting. And as we leave the 2-day chart, check out our last chart for the day. We go to the 4-hour. We see 2 days of hammering down strong movement on gold. And of course, once we have this 2-day chart finally cross back over going down, we might have the ability to jump into further down trades on gold. Remember, the pressure in gold is still down with that weekly vertical crossover still in effect. Folks, that's where we are as we end the week. Like we said, market's a little bit unsettled, waiting for some things to shape up. We'll be looking for that to happen over the course of this next week. The one chart we have that is a potential for trading opportunities is TLT 20-year bonds. If we have that pullback on the 4-hour chart and resumed upward movement, that might offer an opportunity for you. And we'll be waiting for gold, for the NASDAQ 100 and for the S&P 500 to sort themselves out. We love to hear from you. Don't hesitate to write us, cw@chartingwealth.com. Buy the book. Be a Patreon supporter. Seek reality every day. That's what we talk about here at chartingwealth.com. Pay attention to the charts, not the noise. Separate the signal from the noise. Reality, reality, reality. Exist in reality if you want to have success. God bless. All the best from the whole team here at Charting Wealth World Headquarters.